Welcome to St. James Court, right here in the heart of Old Louisville in Louisville, Kentucky. I'm Lindsay Vallandingham with the Symphony Group. We represent buyers and sellers looking to sell and purchase homes in the greater Louisville area, including Southern Indiana. Today, we're going to talk about mortgages, and we're going to talk about some really specific types of mortgages that I keep hearing thrown around out there, and I want to provide a little bit of clarity. We're going to talk about the difference between assumable mortgages and subject to property acquisition. First up, let's talk about assumable mortgages. An assumable mortgage is exactly what it sounds like. You are assuming the mortgage of the previous owner. So a buyer would come to the table and attempt to assume the exact terms of the previous owner's mortgage. Now, these are only an option typically with federally backed loans, an FHA loan, a VA loan, maybe a USDA loan. Those loans typically have terminology within them that says that the mortgage may be assumed by another party. What that means is that the new owner is going to be able to take the balance of that old mortgage, the interest rate of that old mortgage, but they become the new property owner and they simply assume that person's mortgage. That mortgage is moved into the new owner's name. Now, this sounds like a great idea. Obviously, it isn't always available, but the biggest issue that we come across here is that the balance of that mortgage might wildly underrepresent the price of that home, right? Someone's mortgage might be for $200,000, but they're selling the home for $400,000 because that's what it's worth. So in order to assume someone's mortgage at $200,000, me, the buyer, would have to come up with the difference there. So that's $200,000 in cash that I've got to come up with to make the seller whole and thus then assume that mortgage. The benefits here are that that interest rate could be a lot lower than the interest rates we're seeing today if you're able to assume a mortgage from someone who was able to lock in a rate a few years ago at around 3%. That can be a tremendous benefit. You would be able to assume the interest rate of that previous owner. So if that owner purchased the home a few years ago, maybe they've got a 3-4% interest rate, you as the new owner would be able to assume that interest rate. There's some hurdles here. There's some challenges here. You have to be able to qualify under the exact terms that that loan was taken under. So you have to be able to qualify for the mortgage. You have to be able to qualify for that mortgage payment. To be entirely honest with you, banks don't love this, right? Obviously, the bank is going to make more money on a new mortgage at 6.5% than they're going to make on an old mortgage at 3%. So there's some roadblocks, there's some red tape that you kind of got to get through. It can take a long time to get the bank on your side to cooperate here with the assumption of this mortgage. So it's not the quickest and easiest process, but if you find a seller that is willing to go through that process with you, it can become a great option for you as a buyer to be able to assume that mortgage and that interest rate. The other challenge, of course, being that you've got to have a lot of cash in some situations where the value of the property is significantly higher than the mortgage balance on that property because you've got to make up that difference with liquid cash. The alternative to this idea of assumable mortgage is what's called a subject to property acquisition. And this one has been the hot terminology of the summer. I have heard this over and over and over, people talking about acquiring a property subject to. And what does that mean? And what is that? And is it even legal? So a subject to property acquisition would mean that you are subject to the previous mortgage on the property. These have been around forever. They've been commonly used by investors. And basically what it means is that the new buyer simply starts taking over the payments of the previous mortgage. Okay, so that person has owned that house for however long they've owned it. They've been making their payments. And then all of a sudden you, this new person, come in and you just start making the payments like nothing ever happened, right? The bank still gets their money. The seller is out of, the trouble, or they're moving on, or whatever they're doing. And you just simply start taking those payments over. There's a legal way to do this. Most folks would hire an attorney and maybe put the property into a trust so that this can be a little bit more legal. But frankly, if it kind of sounds illegal, it's because it kind of is a gray area. Sellers love this idea because if they get into trouble, they're facing foreclosure, or they are facing maybe the need to move very quickly, like they get relocated for work or something, they have to leave all of a sudden. This can be a really quick and easy way for someone else, this house, to just become someone else's problem, right? Like, okay, great, you're just going to start paying for it and you can live here and whatever. The deed, you actually add the new buyer's name to the deed. So the deed then would have both the seller and the buyer's name on it, and the buyer is legally making payments. You also would contact the mortgage company and say, I've changed my name and I've changed my address. And they would just start collecting payments from this new person's name. And it happens this way, and people are doing it. The thing is, most mortgages have a little clause in there that say that they are due on sale. The vast majority of mortgages are due in full at closing. So when we buy a house, that's like, great, you've paid for it, and you pay off the balance when you transfer the deed to a new owner. And so all of these mortgages that have that clause in there can demand that payment, that balloon payment, that lump sum that is due on the remaining balance of that mortgage with this transfer. So you're kind of wishing and hoping on a prayer that the bank doesn't notice that you just transferred to a new owner. That's a definite negative here. Other potential negatives for the seller who is passing this mortgage on, if that new owner doesn't make their payments, that's on your credit. And that can be a really sticky situation, because all of a sudden you think someone's paying the mortgage and you think everything's fine, and you learn that you're in foreclosure, that your credit has been negatively impacted because this deed transfer didn't actually take place and the property is now not being paid for by anybody. That can really wreak havoc on your credit. But there are not only negatives with a subject to property acquisition, there can be positives as well. As I mentioned, if you're a seller who is facing foreclosure, facing a necessary relocation, the fact that this is quick and easy could be a huge benefit to you. If you're facing foreclosure because you're not able to make your payments, having someone be able to step in and make your payments can be a massive release and can actually save your credit, right? Another benefit is for the buyer. If you have a lower interest rate than the interest rate that's available on the market today, it can be a real benefit for that buyer to inherit a payment and an interest rate that's significantly lower than what they would be able to get in the market today. And another benefit to the buyer is that they are simply acquiring a mortgage that has already been paid to some extent. So they're maybe earning some immediate equity in the property. Now, if you're a seller with a mortgage of $200,000 on your $400,000 home, you might be open to a subject to transfer, but you might want to ask that buyer to pay some of the difference in that equity, because they are simply inheriting a $200,000 mortgage on a property valued at $400,000. So the seller might ask for some lump sum of cash to help cover some of that equity. But for a buyer being able to take over a mortgage at a lower interest rate, they can move quickly. They're not going through financing. They're not making sure that they're qualified for the loan. They simply start taking over the payments. Because this is such a tricky gray area, I would highly recommend you speak with an attorney, talk about the trust process, talk about the process of making sure that this is done legally, and know that even in so doing, you may still face that mortgage lender coming back and saying that the balance on the loan is due. That is a risk that everyone takes in acquiring these subject to properties. They tend to work well for investors, especially investors who have the intention of flipping, renovating the property and reselling it, because they would be able to cover that mortgage claim should it arise. They would be able to cover that balance with the sale of the property. So that's where this tends to work better. But it can work even for a regular homeowner, so long as everyone is on the same page. You've identified with an attorney what the problems that may come up may look like, and you've accepted the risk that goes along with it. If you have questions about acquisition, if you have questions about mortgage assumption, by all means, reach out to us at symphonyrealtygroup@gmail.com.